Welcome back to Citi Market Watch. This is episode 9, and the plan today is to highlight style. So let me first introduce Audrey Cheong, Citigold Private Client Portfolio Counselor. All style and all substance.
And don't you forget it, son.
Thanks, Audrey. But more than ever, this is exactly what we need, style and substance. As we have highlighted in previous episodes, whilst the broader economic reflation remains on a solid and steady trajectory, we are concerned about the creeping headwinds like the Delta variant, the deceleration in economic and market data, tapering, seasonality, taxation, the tolls of climate change weather disasters, and so on. All these headwinds contribute to peak everything and the need to focus on what can navigate the rough waters through the months ahead. Audrey, could you share some quick thoughts on styles?
Investment style is the philosophy or method for selecting portfolios, and they are generally characterized as growth, value, momentum, and quality. Growth is focused on companies that are expanding rapidly in size and importance in their sectors. Our value is concerned about owning shares at a good price that is underpriced by the market. And momentum is quite interesting, where contrary to the maxim buy low and sell high, momentum is about selling losers and buying winners, or buying high and selling higher. And lastly, quality is focused on a company's ability to return cash to shareholders.
And so when we think about growing headwinds, we really want to focus on quality. As economic growth decelerates and yields look to rise or normalize, this will hit growth-biased companies as growth companies have more future cash flows, which get more heavily discounted. As earnings growth and revisions also moderate, momentum will naturally slow as well. Value always has its intrinsic appeal, and it is certainly well romanced by all the keen followers of Warren Buffett. But cheap or bargain companies can be a contraindicator as we remain in a reflationary mid-cycle. Audrey, what are some of the key quality factors that investors should note?
Firstly, as with all the styles, there is no hard and fast rule but soft characterizations. Now, how you mix these factors up is very much the secret sauce and art to the science of investing. Within quality, the most typically referenced factors are free cash flow yield and return on equity. Return on equity is a quality factor and looks very simply at a company's ability to use equity to make profits. It is price agnostic, that is, it offers no relative measure of value. Free cash flow yield is a quality value factor and measures the level of free cash flow a company produces.
Broadly speaking, quality companies reflect strong balance sheets, predictable earnings, and sustainable business models. This is not a recommendation, but when you think about companies like Microsoft or Johnson & Johnson, or everyday services and apps from Spotify, Apple Music, your cloud account, Netflix to Adobe, these companies reflect quality virtues. An example of a key relatable characteristic is their recurring revenue subscription model and bundling. Adobe, for example, receives approximately 86% of its total revenue from subscription sales. Looking at performance, the MSCI World Quality Index has significantly outperformed the MSCI World Index for the last 30 years, with lower volatility and smaller drawdowns.
So it's not necessarily exciting, but it quietly does the job.
All style and substance, Audrey. And as legendary investor George Soros said, if investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. Whilst we are not saying that infrastructure is quality, I do want to pivot and highlight infrastructure as a worthy asset allocation and strategy. Audrey, what's happening in infrastructure?
Thanks, Dan. Well, if you're thinking about stability, recurring revenue, and subscription models, you really can't go past typical infrastructure assets, especially utilities, telcos, and toll roads, for example. Now, all these reflect stable businesses, strong and stable earnings, and dependable yield. What is igniting additional interest is the aggressive infrastructure policies we are witnessing post the pandemic. The US recently passed its $1 trillion bipartisan infrastructure bill, and this was followed by the $3.5 trillion budget reconciliation plan. Now, this is in addition to the previous $1.9 trillion American Jobs Plan. Both have a heavy emphasis on traditional infrastructure, in addition to the largest investment in climate change resiliency.
Thanks, Audrey. COVID-19 has really been a structural policy catalyst. To support their economies, governments have rallied behind broad infrastructure initiatives to provide short-term lifelines and build more enduring and sustainable growth. Global infrastructure is getting a mighty synchronized lift. Aside from the US's initiatives, across other major economies, the European Union rolled out its $2 trillion recovery plan, incorporating its 790 billion euro recovery fund and the EU's next-gen budget. In addition, China's latest 14th five-year plan and declared 2060 net zero targets sets the stage for significant capital spending and investment. China is already spending 10 times more than the US on infrastructure. Globally, the energy sector is responsible for 80% of CO2 emissions. And if the 2050 net zero goals are to be achieved, IRENA, or the International Renewable Energy Agency, forecasts $130 trillion in necessary investments. That's a cumulative and average investment of $4.4 trillion per year on renewables, electrification, and infrastructure. That includes EVs, energy storage, digitization, flexible demand management, smart meters, 5G, cybersecurity, ultra high voltage transmission lines, and more.
Given the catastrophic weather disasters across the world this year, record-setting temperatures, and the IPCC code red report, all these efforts couldn't be happening sooner. But it is important to note that whilst the energy revolution is acute, the pandemic has highlighted gross social inequities, and we are seeing for the first time in decades a direct response to solve these issues. Our efforts, therefore, to improve active transportation, that is, using technologies to build smarter cities, and or just making access to walking and biking safe, encourages healthier lifestyles and has very profound positive health effects, both on individuals and local communities. Now, we are also seeing significant investments into broadband internet access, which is crucial and pivotal in ensuring equal opportunity for all.
Thanks, Audrey. Here are the key takeaways. There are growing headwinds conspiring to stir up more market volatility. In this context, be mindful about different investment styles, and we are highlighting quality. The ability to be agile across all styles and across different asset classes and market cycles is why we see value in active managers. Quality is reflected across all asset classes and strategies. Infrastructure lends itself to some of the core factors that drive quality, but we see aggressive government policies on infrastructure as offering considerable support and tailwinds. Please do contact your Citigold or Citigold Private Client Relationship Manager for more information and opportunities.